Hello and welcome to Economy and Markets TV, where we have conversations with a purpose. I'm your host, Dave Oakenquist, Senior Research Analyst here at Dent. Joining me, of course, is the founder of Dent Research, Mr. Harry Dent. Harry, how are you today?
Hi, Dave. Good.
Great to talk to you and join with you again as we did, I believe, 2 weeks ago. Since then, there's been a bit of action, which actually happened on Wednesday, which was really the biggest thing. The Fed cut rates by a quarter of a percent, really as expected. I mean, there was some of that outside shot of a 0.5%, but that didn't happen. There was even a rumor that they might launch a QE program on the back of what the ECB did last week, but that didn't happen. We just got a 0.25% rate cut, rather. But something also, I know something you mentioned, we talked before we started, there might be the beginnings of a liquidity crisis. Maybe the New York Fed had to do some repo action to kind of tamp down rates and to give some injection of cash in the banks. What do you make of this, Harry?
Yeah, overnight on Monday, the overnight borrowing rate for banks shot up to 10%. It should be darn near nothing. And so that means somebody needed money. And of course, the explanation, well, it was quarterly tax deposits by corporations through banks. Yeah, that happens every quarter. So yes,
Right.
that would make that time a little more vulnerable, but that was not the reason. You don't get a 10% spike because of that. So that means some banks were in trouble covering liquidity over something. Something happened they couldn't cover. The Fed, 2 nights in a row, had to inject substantial amount of money. Now, the important point, they haven't done that since 2008 in the early stages of the last crisis. So I just count this. That doesn't mean you're going to have a crisis tomorrow morning, but this is an early warning sign. Things like this start to happen. And it doesn't take much when you're this bubbled up and this stretched in stimulus and everything else in zero interest rates. It doesn't take much to kind of shock the system, and then you get this kind of like something that gets out of control. So we'll keep an eye on that. They made it like no big deal. I would call this a little big deal.
Yeah. Yeah, absolutely. So I want to just step back just a second. Now, Chair Powell hinted at another rate cut in the future, but I also want to get your take. Do you think we could see, if this is a liquidity crisis, can we see QE in our future? Is that also a possibility? Maybe within the next, maybe the December meeting or shortly after that?
Well, here's how I read it. Trump is really on them to both. He wanted a 50 basis point cut and saying we're going down to zero. In other
Right.
words, he wants the Fed to be ahead of this. He wants them to catch up to Europe and Japan, which are really at zero rates and much more strong QE. And again, Europe is revamping that. Japan never stopped. They've been at 3 times our rate forever. So he wants them to catch up, which is really not the prudent thing to do. But as a Fed chairman, Powell can't do this. Trump is overplaying his card here, from my opinion. The more he demands it, the more they can't do it and look like
Right.
they're cowing to Trump. So here's what I think happened. If there is some stumble, I mean, one of our scenarios in stocks is that we can't break through this megaphone pattern and test, which we're very close to near term, and we go back and take another correction down. It could be 20% or so. If we see a correction, if we see bond yields keep going down, which is saying the bond market seeing slowing, not just US, but global growth, that gives the Federal Reserve a real excuse to do what Trump wants and do that 50 basis point cut and start to be cutting more aggressive and potentially restart QE. Yes. So I think that's what would do it. And I think that's a backstop here. I think one way or the other, we are either going to see this breakthrough to new highs and it just follows through. And by early next year, maybe January, we have a potential peak in this bubble. And if I see down NASDAQ 10,000, I'm going to be ringing the bells because that would be my best target on the high side and say, oh, this is the blow off. If we do have a correction first, I think that's what would stimulate one final rally. Just from lower levels, we might see NASDAQ make a slight new high, 8,500, maybe 9,000, and in a perfect divergence where the S&P and Dow don't make that new high. That's what you look for at the top. A divergence between major indexes. And we already saw that at the last top where the small caps and the transportation didn't make new highs when the S&P and Dow did. Well, if the NASDAQ makes new highs and those don't, boy, that's a really strong. So one way or the other, I think we probably have one more rally before this peaks. And it's just the stronger one, earlier one would peak earlier. And it could be as late as, I don't know, late April, early May for this second scenario we correct first. So that's what we're looking for. That's going to be a big topic at IES. Why we have Lacey Hunt there, the only economist that gets these debt bubbles and how they call financial asset bubbles and why they have to deleverage to get healthy again. Economists just don't understand that sort of stuff. And of course, you just did an interview with David Stockman. He's the only guy. He's like me. He's not actually a fully trained economist, but he's got the political, government, financial side down on these bubbles and debt crises. And I've got, of course, the demographic and cycle side down and more fundamental stuff. So we really, I mean, Stockman, me, and Lacey Hunt, and then we always have a Q&A that's the highlight of IES. And of course, this year, and we have him every couple of years, Gordon Chang. Gordon Chang is the guy on China that knows they aren't as great on the inside as they look on the outside to clueless economists, just like Japan. The same thing. Japan was ready to collapse in the late 80s, and economists thought they died and gone to heaven. So that's what we're saying. Gordon Chang gets this, so we made sure to get him to this conference. So I'm telling people, I think this is probably the most important IES conference for timing. So if you haven't thought about going now, I'd say get to this one. And it's it's in DC on purpose. Another reason Stockman is our keynote speaker, because he's so strong on the political side of this whole bubble and debt crisis.
Yeah, absolutely. As you mentioned, I spoke to him earlier this week. That's an Economy of Markets. Check that interview out. I mean, we only spoke for just maybe 10 minutes or so, and it's just he has a wealth of knowledge, just sort of scratching the surface. Same thing with Gordon Chang, and we could talk about the China stuff, the Hong Kong, and of course, Dr. Lacey Hunt, whose knowledge of economics is very deep.
Dave, real quick, I am so happy to see Hong Kong protesting.
Yeah.
China does have the most top-down oppressive government of the stronger countries in the world. They're doing all the wrong things, and people think they're doing the right things. And my problem is revolts like we're having here and around the world in this whole political revolutionary cycle, the first one since the democracy in the late 1700s. You need young people to revolt, and China is really lax on. It doesn't have enough young people.
Right.
And so in Hong Kong, though, they are rioting and they're protesting. And, they're like the Puerto Rican protests I just saw here when the governor and some top officials really did some really bad stuff under the table, talking about things. They just protested until the governor stepped down. They didn't stop. So I love this Hong Kong thing. I love to see the Chinese protest, because China needs a big reset. China needs to get a more democratic government. China needs to have free market capitalism, not state-driven capitalism. That's the worst. And this is where David Stockman and I agree so much. The economists think, state-driven capital, that's the best of both worlds. That's the worst. The greed of capitalism driven by a government that wants to please people today and overspend and overborrow. It's the worst of all worlds. And China is going to prove this, as if Russia didn't already. And Japan's boom ahead of us was very top-down, over-investing, over-leveraging, over-stimulating as they urbanized rapidly. And look where that ended up. Japan is still on the bottom 30 years later. So China's not going to take that long because they still have more urbanization. But China could take 3, 4, 5 years later than everybody else to come out of this downturn. I think they're down and out for closer to a decade before they can come back. And then it's not demographics, it's only urbanization. So my latest article in Leading Edge, anybody look at that in October. India is the next China. Everybody argues with me on that, but everybody argued with me about the collapse of Japan in the late 80s. It was crystal clear from my indicators, crystal clear.
Absolutely. And yeah, Harry, the IES is coming up next month at National Harbor, October 10th through 12th. You do not want to miss it. You get a chance to meet those great guys like David Stockman, Gordon Chang, Dr. Lacey Hunt, and of course, Harry Dent. You can grab Harry by the sleeve and ask him any question you want, right, Harry?
Even in the bathroom.
Also, and you gave a little bit of your market update. You wrote about that this week to Boom and Bust subscribers in much more detail. So definitely sign up for Boom and Bust to get all of that from Harry Dent.
Yeah. Now, 5-day forecast is where we really give the best market updates. So yeah, we did give a big update, and I'll tell you about when we do that again in another week. So I'm hoping we're getting a clear pattern that we're either breaking up the upside or we start to pull back again. And now at least we know the downside scenario is more likely, and that's equally opportune for that last rally. So we'll see. But I mean, That I also have to explain real quick today. All our subscribers, our long-term predictions are deterministic. There's only a few important cycles which we identify. So it's not two scenarios. It's always one scenario. It just may happen a little more, a little less. In the short term, I always have to boil it down usually to at least two scenarios. I try to get to two scenarios, but the reason for that is so as it unfolds, you get more to that one scenario. But short term, there is no one scenario because politics are so important. And we don't know if this trade deal is going to work out or not. I think not, but it could any day. And that would take the market straight up. I mean, 10% overnight almost. So that's the short term. So I'm always just keeping you apprised of the scenarios and what's most likely. That's the best we can do in the short term, but that's a lot better than not knowing at all.
Yeah, absolutely.
An educated guess is better than clueless.
For sure. Harry, thanks so much for joining me. I think maybe next time we'll go over a couple of reader questions that have come in. Keep sending those in. We just didn't have time to get to them today. Send those to tv@economymarkets.com. For Harry Dent, I'm Dave Okenquist, and this has been Economy and Markets TV.